It's time to recall Fibonacci levels. In this lesson, you'll explore the most important Fibonacci retracement levels used by traders. You'll learn how these levels help identify potential reversal zones, gauge correction depth, and build more strategic entry and exit plans. Let's start. Quick check. Select 3 percentages commonly used in Fibonacci retracement. Great job. But you might be wondering why 38.2%, 61.8%, or 78.6%? These percentages aren't random. They're based on a special number sequence found in nature, art, and even human behavior. Fibonacci levels come from a number sequence where each number is the sum of the two before it: 0, 1, 1, 2, 3, 5, 8, 13, 21, 34. When you divide one number by the next or by others in the sequence, you get ratios like 61, 8%, for example, 21, 34, 38, 2%, for example, 21, 55, 23, 6%, for example, 13, 55. Fibonacci levels work because prices move in waves, not straight lines. After a big move, traders expect a pullback. Since many watch levels like 38.2%, 50%, and 61.8%, they often trigger real buying or selling reactions. Hence, here are the key levels traders use: 0.236, 0.382, 0.5, 0.618, 0.786. Even though 0.5 isn't from the Fibonacci sequence, it's widely used because markets often retrace about half of a previous move before continuing. Traders use Fibonacci levels to spot potential reversal points after a price move. They draw the levels from a recent high to low in a downtrend or low to high in an uptrend. These levels act like guideposts showing where price might pause, bounce, or reverse. In an uptrend, traders look to buy when the price pulls back to levels like 382 or 0.5. In a downtrend, they may sell if the price retraces to 0.618 or 0.786. This helps them plan smart entry points, place stop losses, and choose profit targets. Quick task. Let's recall the Fibonacci trade steps. Arrange the steps in the correct order to plan a Fibonacci-based trade. Time for a quick quiz. BABA has pulled back to the 61.8% Fibonacci retracement level after a strong upward move. What action would you take based on this setup? Buy. Enter long, expecting a continuation of the uptrend. Wait. Monitor for more confirmation above the 50% level. Sell. Expect a breakdown below the 61.8% level. Avoid trading. Too much uncertainty in the move. No, the correct answer was buy. Enter long, expecting a continuation of the uptrend. Not quite. Traders often look to buy at 0.618 during a pullback in an uptrend, especially when there's a bounce forming. You've now mastered the basics of Fibonacci retracement, what the levels mean, where they come from, and how traders use them in real trading decisions. Next, we'll explore how another Fibonacci tool is used, not for finding pullbacks, but for projecting future price targets. Fibonacci retracement versus extension. In this lesson, you'll discover the difference between Fibonacci retracement and extension. By the end of this lesson, you'll understand how to apply each tool to real setups and use both to build a complete trade plan. As you already know, traders use Fibonacci retracement levels to predict where the price might pause or reverse before continuing. There is also a tool called Fibonacci extension, which helps traders estimate how far the price might go after the trend resumes. While retracement levels focus on pullbacks within a trend, Fibonacci extension is used after the pullback ends to project how far the price might move in the direction of the trend. It helps traders set realistic profit targets based on previous price action. Let's see how it works and how to set it up. Before using Fibonacci extension, you need to spot a clear move in the market. In an uptrend, look for a price swing from a low, 0.2, to a high, 0.1, and the end of the retracement, 0.3. In a downtrend, look for a swing from a high, 0.1, to a low, 0.2, and the end of the retracement, 0.3. After a strong price movement and a retracement, traders often want to know how far the price might continue in the original direction. Fibonacci extension levels offer zones where the price may reach before losing momentum. In an uptrend, once the price finds support at 0.3 and starts rising again, traders may enter a long trade. Fibonacci extensions like 1,272 and 1,618 serve as common take-profit targets, while a stop-loss is placed just below 0.3 to manage risk. In a downtrend, traders use Fibonacci extension to project targets below the previous low, typically at 1,272 or 1,618. They go short after the retracement ends at 0.3 and place a stop-loss just above that point. Fibonacci extension is a useful guide, but not always exact. That's why traders combine it with tools like support, Josh resistance, trend lines, moving averages, RSI, or MACD to confirm stronger trade setups. Now that you know how Fibonacci extensions work and how to apply them in real trading situations, it's time to put your knowledge into action. Time for a quick quiz. Price has broken below the 1,272 Fibonacci extension level after continuing the downtrend. Momentum remains strong, and no clear reversal signs are visible. What action would you consider in this situation, Shir? Close all trades, avoid any further risk at this stage. Go short. The break below 1,272 suggests strong bearish momentum. Go long, the price has dropped too far and might reverse soon. Wait. Monitor for signs of exhaustion or reversal before entering. No, the correct answer was go short. The break below 1,272 suggests strong bearish momentum. Not quite. Without a strong reversal signal, going long or closing early may miss the ongoing trend opportunity. Time for a quick quiz. Price has broken above the 1,272 Fibonacci extension and is now heading toward the 1,618 level with strong bullish momentum. There are no clear signs of reversal yet. How would you manage your position in this situation? Avoid trading. Wait for the price to settle before making a move. Open a short. Price is near resistance and might reverse soon. Hold the long trade. The trend is strong and may continue to 1,600. No, the correct answer was hold the long trade. The trend is strong and may continue to 1,618 or higher. Not quite. Exiting or shorting too early could cut profits short if the trend has room to run. You've now learned how to use Fibonacci retracement to spot pullbacks and Fibonacci extension to project price targets after a trend resumes. Next, we'll explore how to combine Fibonacci with indicators like RSI and moving averages to build even stronger, more confident trade setups. It's time to combine indicators. In this lesson, you'll learn how to enhance your trading decisions by combining Fibonacci retracement and extension levels with the Relative Strength Index, RSI, and moving averages, MA. By the end, you'll understand how these tools work together to identify high-probability trade setups. Knowledge check. Do you remember? Let's match each indicator with what it helps you see in the market. A confluence happens when two or more technical tools point to the same area on the chart. This overlap gives that price level more importance and makes it more likely to trigger a strong reaction. For example, imagine the price is pulling back in an uptrend and reaches the 61.8% Fibonacci level. At the same time, the 50-period moving average is right around that zone, and RSI is near 45, showing fading momentum. Together, these signals create a confluence zone where a bounce is more likely. When price reaches a confluence zone, for example a Fibonacci level that aligns with a moving average and confirmation from RSI, it signals a potential reaction area. That reaction could be a bounce in an uptrend, where traders look to go long, a rejection in a downtrend, where traders look to go short. Time for a quick quiz. Price has retraced to the 61.8% Fibonacci level while also touching the 50-period moving average. RSI is near 56 and rising. Based on this setup, would you consider this a confluence zone? Not sure. Need more time to evaluate price action. Yes. Multiple indicators align at the same price zone. No. RSI isn't low enough to confirm a reversal. No. Only Fibonacci is relevant here. Yes, you're right. Correct. The 61.8% Fib, the MA, and supportive RSI together form a strong confluence signal. What if there is no confluence? In such a case, it's usually best for a trader to stay cautious. Without multiple indicators aligning, the setup is considered weaker and carries more risk. In these situations, traders often wait for stronger confirmation, such as a clear candlestick pattern or shift in momentum, before taking action. Time for a quick quiz. Price is reacting near the 61.8% Fibonacci level. The moving average is slightly below and RSI is around 57. Based on what you see, would you consider this a valid confluence? No, the indicators aren't clearly aligned. Yes, all tools point to the same area. Yes, price bounced near the Fib level. Maybe, RSI confirms, but MA is too far. No, the correct answer was no, the indicators aren't clearly aligned. Not quite. One indicator reacting is helpful, but confluence needs at least two or more indicators pointing to the same zone. Now that you know how to use Fibonacci levels, RSI, and moving averages together to spot confluence, it's time to apply what you've learned. Let's put your skills to the test with real chart scenarios. Time for a quick quiz. Price is approaching the 382 Fibonacci retracement level while the RSI is recovering toward 50. However, the 200-period moving average is still above and trending downward. How would you approach this setup? Buy, price is recovering and RSI is rising. Wait, there's no strong confluence yet. Sell, price is near. Yes, you're right. Correct. With no strong alignment between MA, Fib, and RSI, it's better to wait for more confirmation. Time for a quick quiz. Price is pushing into the 618 Fibonacci retracement level, while the moving average is also nearby. RSI is rising and is currently near 57. Would you consider this a strong confluence zone for a potential long entry? Yes, FIB, MA, and RSI are aligned at this level. No. Yes, you're right. Correct. This is a solid confluence setup. Price meets the 618 Fibonacci level, aligns with the MA, and RSI momentum is supportive. Now you know that when multiple tools point to the same zone, it increases the chance of a market reaction. You also saw why it's important to stay cautious when indicators don't align. Up next, let's test your understanding with a quick quiz.
Price has retraced to the 61.8% Fibonacci level in an uptrend. RSI is stable, and a bounce is forming. What would many traders do? Buy, expecting the uptrend to resume from this key level. Sell, assuming the price will break lower. Short, expecting a deep retracement. Wait, avoid action without RSI and oversold. You're planning a Fibonacci-based trade. What's the first step? Enter the trade. Identify the trend. Draw Fibonacci levels. Wait for a price pullback. Two. You draw a Fibonacci extension after a retracement. Price breaks above the 1.272 level with strong momentum. What should you consider? Hold your long trade. Price may continue toward 1.618. Go short. The price is extended. Stay out. This is unpredictable. Exit the trade immediately. Amazing. Three. The price has broken below the 1.272 Fibonacci extension in a downtrend with strong momentum. What might a trader do? Go long. The price might bounce soon. Go short. The bearish move may continue. Hold. RSI is neutral. Close all trades. The trend is unclear. Amazing. Four. Price pulls back to the 0.382 Fibonacci retracement level. RSI is near 50 and recovering. The 200 period MA is still above and sloping down. What's the best action? Wait. No strong confluence at this point. Sell. Price might fail at 0.382. Buy. RSI is turning up. Enter long. Fibonacci level is enough. Five in a row. Price touches the 0.618 Fibonacci level. The 50 period MA is nearby, and RSI is at 57. What does this suggest? Market is bearish. Avoid trading. No signal. RSI isn't oversold. Confluence is weak. Not valid. A strong confluence zone for a potential long entry. Six. What is the main purpose of Fibonacci extension levels? To project future price targets after a retracement. To identify oversold conditions. To replace RSI and moving averages. To set stop loss points only. Seven. Price touches the 61.8% FIB level and also aligns with the moving average. RSI is near 56. What is this called? Extension failure, trend reversal, pullback zone, ignore other indicators, confluence zone. 8. Why do traders combine Fibonacci with RSI or moving averages? To avoid drawing Fibonacci levels, to remove emotion from all trades, to only follow RSI signals, to strengthen their setups with multiple confirmations. Nine. If price reacts only to the Fibonacci level, but MA and RSI do not align, what should a trader do? Ignore the other indicators. Use Fibonacci alone without confirmation. Enter the trade confidently. Be cautious.